Welcome to International Securities Exchange's podcast series. Facilitated by renowned educators, ISE podcasts are intended to teach beginning as well as seasoned investors the ins and outs of trading. To find an updated list of podcasts, please visit www.ise.com/podcasts. Please be sure to listen to our important message following this episode regarding the risks of investing in exchange-traded options.
Now, moving onward, let's say that maybe all that premium risk is, okay, I see we have a question here from Bruce. Would you gamma trade using the spot market to stay delta neutral and overcome some of the theta loss? Well, this is a question from Bruce in terms of neutralizing gamma. And you could do that. A lot of people do actually go long in the spot Forex market and then sell some premium in the option marketplace, and that would be kind of like an inter-account spread, so to speak. By all means, you can definitely do that, but just understand the risks that are involved when doing that. It's a pretty advanced trade with what Bruce is talking about, and he meant along with your straddle. So let's say that the straddle goes up and you want to neutralize the gamma on it. The spot Forex wouldn't have any gamma in it, so you're totally neutralizing it. Yeah, you could, Bruce, but once again, it's a little bit beyond the scope of what we want to talk about today. If neutralizing gamma is something with which you have interest, on the OptionsXpress website, we have a gamma neutral trading webinar. I just did it a couple months ago. I believe we recorded it, and it talks about it a lot, but it's in relation to stock, but you could still apply the same principles to using the spot Forex if need be. A strangle. Let's say that some of that straddle just costs too much money for you. You still like the idea of being neutral, but you don't like spending all that money on it. That $4,000 kind of gave you a sticker shock, or even $400 gave you a little bit of a sticker shock when looking at it, and you're not really ready for that yet. One thing you might want to consider is a strangle. You're still very bullish or very bearish, you just don't know what. You're still very confident it's going to go one way or another, and you still have that same sentiment, only now you just don't want to risk that much premium. So with that, strangle involves buying an out-of-the-money call and an out-of-the-money put for the same underlying with the same expiration month. Now, you might want to consider using a strangle because, once again, you don't need to predict direction. You just need to predict a lot of movement. The non-movers are still your enemy. Now, the non-movers are your enemy even more in a straddle than in a straddle in most cases. But the good news is that you have a lesser amount of premium risk. Now, the bad news about a strangle is that you're buying two out-of-the-money options. And because they're out of the money, they have a lesser chance of getting that move for you because they're further out of the money. So there's good and bad to everything in trading. Let's go ahead and take a look at the website and take a look at a strangle under the same context. Now we see in here we have the straddle. Let's go ahead and go back to the original area of the trade calculator and show the same thing on the Canadian loonie with that of a strangle. Now the loonie's trading around 123, actually closer to 124. Let's say that we want to buy, I'll say the 127 call option, and we'll buy the 121 put option. And let's do a 10 lot again. Now remember, $4,000 was our risk last time, approximately. This time around, our overall risk comes out to $2,200. We have about half the risk. So with that same concept, and this diagram should look about the same to you, but you'll notice at the bottom here, we're flattened out more. Now, we lose money between 118 and 129. So we have a wider area of which we could lose money, and we need to go all the way, we need to go out further, so to speak. We need more movement before we start making money. Now, once again, this is based upon it waiting until May 15th till expiration. But let's say that we want to look at April 30th again. little over 2 weeks before expiration, we can see what our actual profit and loss may be. Now, this is under the assumption that implied volatility stays the same as well as interest rates. So, nonetheless, you can kind of get an idea of how this works when going through this. Now, let's get back to the screen. Now, let's say that we don't think there's going to be a lot of movement. What we just showed were two ways to where we're looking for a lot of movement. We want to see this thing move in one way or another, and we're just looking to make this thing move. But let's say that we think it's going to stay around the same area, and let's say that we want to sell some premium. Now, as a premium seller, what we just talked about was being that of, I would say, someone with more of a capital gain mentality. You're looking for more of a big score, so to speak. You're looking for a lot of movement. And if I'm looking for a lot of movement, I'm going to want to make a lot of money. Now, either way, with that, if you have more of a mentality to where you want to, let's say, collect a little bit of money, but collect it more frequently, you might want to consider selling premium. Now, when you're going through this as to what type of trader you want to be, I want you to consider the losses as well as the gains. Here's what I mean by that. If you make money 9 times out of 10, which you can do, there are strategies to where you can do that without much problem at all, does that mean that you're going to make money? If you're right 9 times out of 10, does that mean that you're going to make money? And actually, let's type this in the box. How many people say yes? How many people say no? You're right 9 times out of 10. Does that mean that you're automatically going to make money? Go ahead and type it in the box if you would. Okay, we have a no. We have a depends. We have a no. We have a no. Not necessarily. Excellent job, everybody, because you're on page with the next point that I'm about to make. If you make 1% 9 times and then you lose 25% on trade number 10, you're going to have a losing round of trades after a while. But you can lose money 9 times in a row. Let's say you lose 1% 9 times in a row, and you make 25% on trade number 10, then you're going to make money. Now, whichever way you want to go about doing this, what I would suggest doing is really examine your mentality. Let's say, for example, that you need to make money a majority of the time. And if you're not making money a majority of the time, then it's really going to affect your psyche and you don't think you can be a good trader. Well, if that's the case, you may want to consider doing something along the lines of premium selling. Maybe. Now, with that being said, what you need to be ready for is that one time. That one time that you're wrong, you're going to get hammered. You need to respect the market enough to where that one time that you're wrong and the time that the market goes against you and that you get hammered, that you have your stop loss put in place or that you have some type of an option hedge put in place, whatever strategy that you're looking to do. Now, let's say that you're looking to hit the home run. You need to have the mentality, okay, I'm going to be wrong most of the time, but eventually I'm going to hit the home run. Now, does that mean you're going to hit the home run? Good gosh, no. You might never hit a home run. You might be wrong 25 times in a row and lose 100% of your money. That's a very real thing. However, with that being said, you need to be able to stomach being wrong a majority of the time if you're looking to hit the home run. Now, let's say that you want to be right a majority of the time and you decide to sell some premium. A couple of things with which we can do. The condor and the butterfly. We have a request to go over the inverted butterfly. We can touch on that a little bit later. If for some reason that I don't get to that, please bring it up during the, actually, if you can bring it up again during the Q&A section, I'll be more than happy to go over the inverted butterfly.
Thank you for listening to our podcast. To find more podcasts on options, stocks, alternative markets, and market data, please visit www.ise.com/podcasts.